While the retail crowd is glued to Bitcoin's price action, a structural anomaly is forming in the background of the Ethereum network. It's a signal that hasn't flashed this brightly since the 2021 bull run. We are currently witnessing a supply shock so severe that centralized exchanges are literally running out of ETH. As of January 2026, Ethereum reserves on exchanges have plummeted to just 8.8% of the total circulating supply. To put that in perspective, for every 100 ETH in existence, fewer than 9 are actually available to be bought. The rest, it's locked, staked, or held in institutional cold storage. Wall Street isn't just interested in Ethereum anymore. They are quietly vacuuming up the remaining liquidity before the spot ETFs enter their secondary growth phase. Today, we're going to look at the mathematical proof behind a $9,000 price target and why the digital oil of the internet is about to become the scarcest asset on the planet. We are entering a phase where the available float of Ethereum is disappearing faster than the market can price it in. This isn't just speculation, it is a liquidity vacuum that precedes a massive repricing event. Let's look at the numbers. In mid-2025, we saw a massive migration of ETH off exchanges like Binance and Coinbase. Historically, when exchange reserves drop, it means smart money is moving their assets into long-term storage or staking protocols. But this time is different. Currently, over 32 million ETH is locked in staking. That is roughly 27 to 28% of the entire supply that cannot be sold instantly. When you combine this with the ETH burnt by the EIP 1559 mechanism, we are looking at a deflationary pressure that the market hasn't fully priced in yet. We also have to talk about the recent Fusaka upgrade. This wasn't just another technical patch. It refined how Ethereum handles its scaling solutions. While some critics argue that layer 2s are stealing fees from the main chain, the reality is that they are driving massive adoption. As transaction costs drop, the volume of activity and thus the total value settled on Ethereum is exploding. We are seeing real-world asset tokenization, or RWAs, jumping to over $12 billion on-chain. This creates a gravity well for ETH. Think of it like a housing market where 90% of the homes are off the market, but the number of buyers is doubling every month. What happens to the price of the remaining 10% of homes? They go parabolic. This is the scarcity engine of Ethereum in full effect. Why is this happening now? The answer lies in the staked ETF. In late 2025, we saw the turning point when BlackRock and Fidelity moved to allow their Ethereum ETFs to earn staking rewards. This was the game changer for the Wall Street narrative. For an institutional pension fund, Bitcoin is digital gold. It's a store of value. But Ethereum? Ethereum is a yield-bearing tech stock. By holding ETH, these institutions aren't just betting on price appreciation. They are capturing a 3 to 4% annual yield. This makes Ethereum the most attractive collateral in the history of finance. We've seen reports that Bank of America and other major wealth management firms are now allowing clients to allocate significant portions of their portfolios into these ETH products. We are talking about trillions of dollars in sidelined capital that is now being given a green light to enter a market with record low supply. Even as we see short-term sell-offs from major players to balance their books, the net trend is clear. The institutions are building massive long-term positions. They are not trading the 15-minute chart. They are looking at the next 5 years of global financial infrastructure being built on top of this network. Beyond the ETFs, there is a silent giant waking up: tokenization. Leaders in the space have stated that the next generation for markets is the tokenization of securities. Ethereum is the undisputed leader here. From major institutional funds to tokenize US treasuries, the demand for Ethereum as the settlement layer is growing. Every time a bond is traded or a real estate asset is fractionalized on Ethereum, it requires ETH for gas. Furthermore, the smart money is beginning to realize that Ethereum is the only network with the security budget and decentralization necessary to handle trillions of dollars in institutional value. This isn't just about crypto natives anymore. We are seeing major banks use Ethereum as a backbone for their internal ledgers. This creates a constant underlying buy pressure that doesn't care about the daily news cycles. When the world's financial rails move to Ethereum, the token itself becomes the most vital commodity in the digital age. Technically, the chart is screaming for a breakout. We have been forming a massive inverse head and shoulders pattern on the weekly time frame for nearly 2 years. The neckline sits right at the $4,950 mark, the previous all-time high set back in 2021. Once we clear $5,000, there is zero historical resistance. We enter price discovery. Using the Fibonacci extension from the 2022 lows to the 2025 highs, the 1.618 level lands us almost exactly at $8,850. Rounded up by psychological FOMO, $9,000 is not just a dream, it's a mathematical probability based on previous cycle returns. Analysts have even suggested that if Ethereum maintains its historical multiple against Bitcoin, we could see targets even higher than that. But keep an eye on the $3,100 support level. This is where the whale wall is built. If we dip below $3,000, it's not a crash, it's a gift. It's the last chance for retail to front-run the institutions before the supply shock fully hits and the doors to sub $4,000 ETH close forever. We often hear about the flippening, the moment Ethereum overtakes Bitcoin in market cap. While that remains a heated debate, what matters more is the economic flippening. Ethereum already generates more fees and has more active developers than any other chain. It is the most profitable blockchain in existence. As we move through 2026, the market will stop valuing Ethereum as a beta to Bitcoin and start valuing it as a global utility. When you look at the price of oil in the 20th century, it wasn't just a speculative asset, it was the fuel for the entire economy. Ethereum is the digital oil for the 21st century. It powers decentralized finance, NFTs, gaming, and now the global banking system. The scarcity we are seeing on exchanges today is simply the market realizing that there isn't enough fuel to go around for the massive demand that is coming. So what is the play? Most people will wait for the news to tell them Ethereum is at $6,000 before they buy. By then, the easy money has been made and the risk to reward ratio has shifted. My strategy is simple. I am monitoring the staking queue and exchange outflows. As long as more ETH is entering staking than leaving it, and as long as exchange balances continue to trend towards zero, the bull case remains ironclad. Don't let the sideways movement of the last few weeks shake you out. This is the accumulation zone, where the institutions want you to sell so they can buy your coins at a discount. They know they can't buy the volume they need on the open market without sending the price to the moon, so they rely on retail impatience. This is a marathon, not a sprint, but the finish line for this cycle is looking incredibly bright. Hit the subscribe button to stay ahead of the smart money and keep your eyes on the data. I'll see you in the next one.